All right. Thank you guys so much for coming out Monday morning. I know everyone's got really busy schedules, so I really appreciate you guys taking the time and helping enlighten all of us on HECMs, aka reverse mortgages, right? That taboo word that everyone's so scared about. I don't know why. I think there are amazing opportunities for the right people that are out there, right? Really freeing up a lot of cash flow and helping people that are on fixed incomes that have been living in their homes for so long. There's so much equity in, nowadays, especially with this whole generation coming up, right? With baby boomers that are going to wind up, they're going to age in place. I mean, sitting on these crazy rates if they have anything at all. I want to say it was something like 40% of all homes in the United States are all paid off, if I'm not mistaken, right? It's like 41, 42%. It was wild. It's astonishing, those numbers. So, um, Michael, Dan, both are reverse specialists, are leaders in our community for Movement Mortgage, and we work very close together in helping our clients really have all the options that they need, right? And understanding the ins and outs of not only forward purchasing, reverse refinancing, everything. So, without further ado, I would love to hear your presentation. I'd learn something new every single time. So, thank you so much for taking the time to come out with us, you guys.
Absolutely. I'll start. My name is Dan Hultquist. I wear a few hats here. I'm an author of a few books on the topic of reverse mortgages. So I like doing the education work. I'm also director of reverse mortgage communications. So I get to do these presentations and I thoroughly enjoy doing them. Uh, the person who's actually on the working with you as a loan originator and your referral partners would be Michael Joy. Michael, do you want to introduce yourself?
Absolutely. Yeah. Thanks, Dan. Yeah. Michael Joy. I've worked in mortgage since, the mid 90s and, decided for the fourth quarter of my career, there's such a need and I believe so strongly in this product that all I do now is originate reverse mortgages. So we just look at it as an option, and a lot of times it's super powerful to give a client both options, right? Ed's gonna, Ed or Matt or whoever is gonna give you a forward option and here's the reverse option and let them choose what makes the most sense. So, but yeah, I really, really enjoy helping people and that's really what it is. So, thanks for having us on.
No, thank you guys.
Well, this is a presentation called Retirement Mastery for Real Estate Professionals, and it kind of goes through three different phases. We're going to talk a little bit about retirement and how home equity fits into that. Then we're going to talk a little bit about reverse mortgages in general, and then we're going to talk about the HECM for purchase, which really is the biggest impact to you if you're a real estate professional in the call. But one of the reasons I really love giving this presentation is that so little is known about how retirement planning, real estate, which is what you do, and mortgages, which is what we do, all connect to form a more efficient retirement. There's been a lot of research done on this, but not a lot of people understand it. But it's something that Michael and I live through every day, helping clients and real estate professionals and financial planners understand their options. So hopefully I can shed some light on some of those concepts today. But if you're a real estate professional and you're watching this broadcast, either live now or recorded later, you have a lot to gain. Most real estate professionals don't realize how much you could benefit from understanding just a little bit about what Michael and I do with Ed and others that work with Movement Mortgage. You have a lot to gain just by understanding a little bit about how you can buy a home with a reverse mortgage. If your clients are age 62 and older, or in some cases 55 and older, we have products for that too. Feel free to type any questions into the chat and I'll do my best to answer some of those, and Michael will as well. So let's go ahead and get started with retirement mastery for real estate professionals. The first thing I'm going to do is get my highlighter out because we're going to talk a little bit about how we view retirement. We view your working years, your income goes up here into a pre-retirement wallet and it gets filtered down into three different buckets,
Hey,
assuming,
Dan,
yeah,
I don't think the share is working.
whoops, I better do that.
Yeah.
Let's go ahead and share that screen. Good call. Thank you.
Well,
All
Oh,
right.
and just like that, we're all on the same page, folks.
All right. So this is your pre-retirement wallet, and your income goes up to the top here, and some of it trickles down into one, two, and three. And that's assuming you don't spend it all on the cost of living and taxes, right? But some of the taxes that you pay go right back into bucket number one, like Social Security, right? So that's for future income. So when we talk about bucket number one, that's your wages, commissions, pension, Social Security is generally what people think of. If we're good investors, well, we're going to store away some in bucket number two, which we call our nest egg. That's your traditional retirement. That's your IRAs, 401ks, stocks, bonds, other types of traditional retirement assets. But what most people neglect is bucket number three. They don't realize that over all these years of being a homeowner, you've built up a massive nest egg in bucket number three. Now, that's because you put money down, okay, down payments, monthly payments to us, maintenance, utilities, add-ons, upgrades, all the things we do to make a home builds this home equity. And one more thing, and that's appreciation, right? So when you think about the money that we put into our home, because of you, if you're a real estate professional, you built this bucket, right? You sold them the house, we helped them finance it. And ultimately, with all that money they're putting into here, they generally end up with a massive nest egg. They don't view it as part of their wallet, but it is. So when they get to retirement, they usually go right back to bucket number one. Should they? Maybe not. That's not always the most efficient, but it's amazing how many people turn 62 and they file for Social Security. That's terribly inefficient for most of America, but they do it anyway. Why? Because 40% of America enters their retirement years still putting money into bucket number three in the form of mortgage payments. They panic. They think, well, Social Security is money that's available to me and I can surely use it. So I'm going to opt in early. Most of America will file early. Sadly, a large chunk of them will file at age 62 and 63, not realizing that's terribly inefficient. Most of America should wait. They should meet with their CPA and financial planner to determine the optimal time to file. But unfortunately, people make a suboptimal decision. Now, Forbes came out with a study that said the average American will lose $111,000 because they filed for Social Security improperly. That's crazy to think about. That's a lot of money. Now, once they're done filing for Social Security and ultimately they do retire, they go right to bucket number two. Is that efficient? Maybe, maybe not. It depends on your situation, but they start drawing from their IRAs and 401ks. Well, they do it because, well, there's another readily source of cash I can bring in. The problem is most of it is taxable. And when you draw from a taxable source like bucket number two, guess what happens to bucket number one? It becomes taxable too. Up to 85% of your Social Security can be taxable. Think about that. It was created because of a tax. I got taxed, it built up my Social Security account, and then I draw it again and I get taxed again. Why? Because we're retiring inefficiently. Most of America doesn't understand that bucket number three is a non-taxable source of retirement cash flow. Is it a nest egg? Sure it is. It's a retirement nest egg, but most people put a little box around it and they put bucket number three in a corner and they say, I'm not touching that. Why? Oh, that's going to the kids. My kids are going to get a paid off free and clear home. Is that efficient? No, it's terribly inefficient. And the Journal of Financial Planning has seen multiple white papers written about the inefficiency of this. Why should we rely on a two bucket strategy when we have a third bucket that's non-taxable? We can manage our adjusted gross income. Ultimately, you'll have more cash flow with a three bucket strategy, more cash flow, more liquidity, less taxes, and believe it or not, higher net worth. You're going to be able to leave your kids more money by opening up a three bucket strategy, in part because you're going to pay less in taxes. Now, I'm not going to turn it into a financial planning discussion, but these are the conversations that Michael has with your financial planners, your CPAs, tax planners, and of course, real estate professionals, because you're the one building this bucket with us. So how do we leverage bucket number 3 as a retirement cash flow source? It's through the use of a reverse mortgage. And I get it. There's a stigma associated with it. It's crazy. Most people don't want a reverse mortgage, but everybody wants what a reverse mortgage will do for them. Increase cash flow, increase liquidity, lower taxes, and higher net worth. We can show you how to do that with a reverse mortgage. And so most of our clients come back to us and say, man, why didn't I do this earlier? Why did I wait so long? Because there's a stigma associated with it, right? People don't understand it, and they're afraid of the things that are maybe a little complex. We're here to help simplify the process. Now, if you want a proper definition of a reverse mortgage, it's just any loan secured by a home where repayment is deferred sometime into the future. Usually when the last borrower passes away and the heirs sell the home, the reverse mortgage is paid back. Generally not until then. Now, that's a very basic definition. Now, Michael, you're in a higher end area, so you tend to see more non-HECM products. But I know in California, Washington, you're going to have a lot of proprietary products that are available in your area. But still, the vast majority of reverse mortgages are HECMs nationwide. And that's most of what we sell. Michael, what's your product mix right now? I know you're selling some proprietaries.
Yeah, it's less than 10% though.
Okay.
Yeah, proprietary.
So
So
home
probably
equity.
90+% HECM.
Okay. So the HECM is the dominant product in America, in part because it's the only federally insured reverse mortgage product. It's federally regulated, it's federally insured. It does have an age requirement. The youngest borrower must be at least age 62. However, we do protect non-borrowing spouses. So I gave this presentation twice in Beverly Hills. Michael knew I was going to bring that up because that was the first question they asked is, what if the spouse is younger than 62? And I said, is that a pretty common problem there? And they said, oh yeah. They want to know, how low can you go? Yes, we do allow non-borrowing spouses down to age 18. We call that the U zone. We don't like to talk about it much, but we protect that spouse. They get to stay in the home even after the last borrower passes away. So there's a lot of protection now for those who are under 62, married to someone who has a reverse mortgage. So we solved that problem 10 years ago. We just need to get the word out that, hey, non-borrowing spouses are protected. Now, the reverse mortgage allows a homeowner to convert a percentage of their home's value into cash, or what Michael and I really love to see is someone leaving their unused portion of the reverse mortgage in a line of credit because it grows on their behalf. Of course, they get to continue to own and live in their home. Feel free to type in any questions you might have into the chat. I know I'm going through rather quickly, and Michael, you can stop me too if you want. But I want to address some of the misconceptions. Everybody has them. If I were to walk down the streets of San Diego, which I did last week, and say to anyone with gray or silver hair, hey, why aren't you considering a reverse mortgage? The number one answer is, well, I don't want the bank to get my home. That's not the way a reverse mortgage works. We don't take title and ownership of the home at application, at closing, or when you pass away. None of that happens. That's not how a reverse mortgage works. The borrower gets to retain ownership and title throughout the life of the loan. Even after they pass away, the heirs can obtain the home. Is it a last resort option? Absolutely not. Now, I still have 6.5 years to go before I get my 7 years before I get my reverse mortgage. I'm not going to do it because I need it. I'm going to do it because I want more cash flow, more liquidity, lower taxes, and higher net worth with this product. Heirs also don't get stuck with a bill. Now, there's a clause in every reverse mortgage in America called the non-recourse clause that says that the heirs, the borrower, the estate, no one can owe more than the home is worth at the time the home is sold. So if you borrow a lot of money from your reverse mortgage and your property value declines, below that point, there's no deficiency judgment. That's where FHA's insurance comes in. Now, can you outlive a HECM? No, you can't, even though the maturity date is 150. It's the youngest borrower's 150th birthday. No, you can't outlive a HECM because HUD says if someone were to live that long, we would just have them sign an updated security instrument extending to a longer term. Are HECMs expensive? That's probably the second biggest objection we've gotten lately is number one, they think the bank takes your home. And number two, they look at the costs and say, oh, that's expensive. It's only expensive if you don't take a look at the advantages of the product. The costs are similar to a traditional FHA loan, but you're getting so much more. You get a non-recourse loan at extremely competitive interest rates, and it doesn't ask for a monthly principal and interest mortgage payment as long as you occupy the home and abide by program guidelines. That's extremely valuable. Just from a cash flow standpoint, it's very valuable. So no, I don't consider them expensive. In fact, I think it's cheap for what you're getting.
So could we talk about that line of credit for half a second? Is that
Absolutely.
is that coming up by any chance? I don't want to jump the gun.
No, we actually don't in this presentation because with a purchase, most people use all their funds on the day of closing. But let's talk about it for a moment because I think the line of credit may be the strongest selling point of the reverse mortgage.
I think that's an amazing opportunity for a person to be able to pull that money out without having those payments, reinvest those funds, and be able to live off of them. And they're tax free. You're pulling it out tax free.
Yeah, tax-free disbursements. And so it's technically borrowed money, but at the same time, it's a nest egg that you can borrow basically from yourself. And the line of credit itself grows at the same interest rate as the loan balance. So I have friends that have gotten a reverse mortgage, friends in the industry that have gotten them for themselves or their family members, and they only borrowed the closing costs. And they just left everything in a line of credit, knowing that it's guaranteed to grow at the interest rate plus 0.5%. It's fantastic. I mean, I know Michael can tell numerous stories of clients who have used it for strategic purposes. We have people who refinance their multi-million-dollar property with a reverse mortgage specifically for the line of credit. Then they draw that money whenever they need it to, for example, to buy a second home or investment property. We had a guy use a strategy. Michael, I don't know if you remember this one. The guy created a strategy called triple dipping, where he would borrow from his line of credit to buy an investment property. And then as rents came in, he paid down the loan balance and increased his line of credit. And he made extra payments to increase his line of credit every once in a while. And then he bought a second investment property. And as two rents came in, he paid down his loan balance and increased his line of credit dollar for dollar with every payment. And then he says, my plan is to do it a third time, and then I'm done. And we asked him, why three? Like, is it an arbitrary number? He goes, I have three kids. And when I pass away, they're all going to get a paid off free and clear investment property, not my primary residence. They don't want to live here, but all three of them are going to get an investment property because of this strategy. And he used the line of credit to do it. Didn't have to take money out of his retirement savings. It's a brilliant strategy.
That's so smart.
And you think the realtors were happy?
Well, yeah. Well, he's obviously not buying places in San Diego. I'll tell you that much. Not with that strategy. But that's brilliant. I mean, just to keep doubling down like that. And
we had another woman recently.
And you're owning the other properties free and clear.
Yeah.
Yeah. Yeah.
That's brilliant.
Yeah, I see that strategy a lot for second homes, especially people up in the Northwest that want to get down and to San Diego or Palm Springs or Arizona and buy a second home. So they'll take the reverse out on their primary home in Washington, turn around and use some of that cash to put down on the second home or the investment property. I mean, that's a huge use as well. So
That's
Yeah,
so
Michael
smart.
makes a good point. A second home in San Diego is going to be expensive, but now they don't have to draw all of that money from their IRA and 401k to do it. So they can draw some of it. Obviously, the reverse mortgage can only go so far, but it's brilliant strategy.
Oh, that's great. Thank you for
Yeah.
enlightening us a little bit more on those.
Now, when I got into the industry, almost all of my clients were at level one right here. They're desperate. This is going back to 2008, 2009. I mean, a very difficult time in the mortgage industry, the real estate industry, right? Um, Almost all of my clients were desperate. They were house rich, cash poor, and they need money and they need money now. Could we help them? Yeah. It's just a small piece of what Michael does, though. He's moved on. You know, we help them? Sure. And it's very satisfying when we can help someone in crisis mode. We called it crisis management. We call them needs-based borrowers. There's a critical need and we can satisfy it. But that's such a small portion of what we do. We've moved on to level two, which would be lifestyle enhancement. Maybe somebody wants to update the kitchen or the bathroom to meet their physical limitations, or a stair lift, or buy a new car, or travel to see the kids and grandkids without drawing more from the retirement savings because their CPA says you got to stop drawing from your IRA. So there are a lot of lifestyle advantages, but what Michael's really good at is right here at level three, where he starts talking about the financial planning advantages with your tax planner, your CPA, your real estate professional. But where this really hits home with the real estate professionals, if I can find my highlighter, it's right here. You can buy a home in two different ways. We already talked about one of them. Get a reverse mortgage on your existing property, leverage enough money that you can go buy your second home or investment property. That's one option. The second is I'm going to sell this home. I'm going to list it with one of the real estate professionals on today's call. I'm going to list it, sell it, and I'm going to take a portion of those proceeds and buy my next home because I'm going to finance it with what's called a HECM for purchase. It's a fantastic option. My uncle just did this. My uncle just sold his home in Florida. He was able to net over $600,000. He wanted to move to the Midwest to be closer to family. And he said, Dan, I could buy a home here in Oklahoma in cash and it wouldn't be a problem. I'm looking in the 400s, right? And I was able to net in the 600s. So I've got extra money left over. I could buy it in cash. He said, would you? I said, absolutely not. No, because I can finance 50% of the sales price with a product that doesn't carry a monthly principal and interest mortgage payment, which means now instead of having $200,000 in your pocket, you have $400,000 in your pocket. Now, if you have $400,000 after this transaction and you move to Oklahoma, what would you do with $400,000? He goes, I would go right to my financial advisor and say, okay, now what do I do? It turns out he bought an annuity. He improved his insurance, his life insurance, long-term care policies. He was able to invest some in the market, and then he's got some that he's going to keep just for emergency purposes. His life's forever changed. He called me up the other day and said, Dan, I was able to complete the reverse for purchase with Movement Mortgage, and I've never, ever felt financially at peace like I have right now. I've never felt like I had enough money that myself or your aunt, my aunt, obviously, it was his primary concern, but he says, I'm never going to have to worry about money again. So it's a great financial planning strategy, but we can use the HECM for purchase in two different ways. Okay, let's talk about the HECM for purchase specifically. And again, if you're a real estate professional, you've got a lot to gain here. First of all, it saddens me when I see that someone in their 70s locks themselves into a 30-year payment. That's irresponsible. I got a chance to speak at the MBA conference a couple years ago, and my opening statement at the MBA conference was, some of you in this room are selling a 30-year fix to seniors, and it has to stop. We can't be doing that to them. Give them a product that allows them to treat it like a 30-year fixed. They can make payments if they want. Treat it just like a fixed rate mortgage. It's going to act the same way. It's going to amortize the same way, but they don't have to make a payment. And that's critical when you're in your 70s. So the HECM for purchase was created to try to keep people from financing using a 30-year fixed or even a 15 or a 10-year fixed. It don't commit them to a required payment, commit them to a flexible payment with a reverse mortgage. They can make a payment if they want. But why is this important to you as a real estate professional? We can increase your listings, we can increase sales, and we can increase your borrower's purchasing power. Now, how do we do that? We increase listings because some people don't relocate because they don't feel that they can. They say, I want to move closer to the kids and grandkids, but I can't afford the houses in their area. Yes, they can. They just don't know they can't, or that they can. So we need to educate them that, hey, the reason you're stuck in a home that's suboptimal is because you don't understand your financing options. We can increase your listings. So if they're 62 and older, we need to open up this option to them. We can increase your sales and we can increase their purchasing power. Can someone with $500,000 in cash buy an $800,000? Can someone with $800,000 in cash buy a $1.2 million? Absolutely, with no monthly principal and interest mortgage payment.
Yeah, so the interest rate, which obviously has been a hindrance for the whole market for all of us the last couple of years, doesn't really matter on a reverse mortgage. It's all about cash flow. If your monthly payment is zero, your monthly mortgage payment, does it matter if your rate's 6 or if it's 3? Your cash flow, you're on a fixed income in most cases, your cash flow is still going to be the same. So it really takes the whole interest rate out of the equation because, pretty much every client that I work with that still has a mortgage, they've got a, 3% give or take interest rate. So we're getting them to do a reverse mortgage for roughly double that interest rate. But the interest rate really doesn't matter like we're all accustomed to. It's all about that monthly payment. And if you don't have a monthly payment, how long, are your other assets going to last? And what can you do with that additional money? So anyway.
Just to play devil's advocate real quick, wouldn't that higher interest rate just eat into the equity that much quicker?
Well, it does eat into the equity a little bit faster, but again, you have the flexibility to make a mortgage payment. And where it's incredible, back to your question about the line of credit, is you've got this bucket of money that's growing every month, every year. But as you make a monthly payment that's optional, but if it's bothering you mentally that, hey, I'm spending all this equity instead of cash, you can make monthly mortgage payments and they show up immediately into your line of credit. Your loan balance goes down dollar for dollar. Your line of credit goes up dollar for dollar. So your bucket of money is still the same size. You're just choosing to put it in a place where if something changes down the road, you've got access to all those payments that you made plus the growth.
You're literally paying for the house out of one pocket or another. I mean, you're either paying for it out of the equity in the house or you're paying with a cash account. Like one way or another, you're paying for that house, right? One of them is just not going to dip into your fixed income that you're living on.
Yeah, and for people that, one of my last loans I worked on Friday before the weekend was from a financial advisor, and it was for a purchase scenario, and it's like, well, would you rather pay $400,000 for the $700,000 house or $700,000? Well, because she could have paid $700,000, she's selling a house with a ton of equity. But the advisor is going to be able to take some of that $300,000 that they're not dumping into their home equity and earn a return on it, probably that would, be higher than 6% on average, or at least comparable to that without taking a bunch of risks. So it really is about, that whole having liquidity and having use of that money versus having the mental pride of having your paid off house. I mean, that's really the stigma that we're trying to get around.
Yeah, so it makes sense.
Let me also add that a lot of people look at home appreciation rates of 3 or 4%. Obviously it's different in every market, but they're looking at 3 or 4% historically, and they're looking at interest rates in the 6 and 7%, and they think, oh, well, that's eroding my home equity. It's not, because the 3 or 4% is being applied to a much bigger dollar amount. And so when we look at the amortization schedule, most of our clients right now are actually gaining equity with a reverse mortgage. Not a lot, but they're gaining some equity. What destroys their equity is consumption, is we are now pulling money out of that line of credit. Well, your equity position will drop instantly, but your cash will go up. So obviously cash is a little more important in retirement than your equity position. So that's one point that I just made at our national conference last week. Is I said, we hear people say all the time it's eroding our home equity. Our statements aren't actually showing that. By the way, Michael and I have a boss who got a reverse mortgage for himself 3 years ago, and he's actually gained a ton of equity on his $1 million property, is now worth 1.3. And he's actually, his interest is actually rather insignificant compared to the home appreciation he's seen. Good point. Let's move on to working with builders. I don't know how many on this call work with builders, but the builders have been telling us that retirees want 4 things when they move into an active adult community or any community where a senior might want to live. They want 4 things. Number one, they want a home priced higher than their net sales proceeds. That's the first thing. Each one of these seems unlikely, right? Well, how are you going to afford that? They also want all the add-ons and upgrades, which is where builders make their money. They also don't want to deplete their retirement savings to fill in the gap between here's how much money I need, here's how much money I have. They don't want to fill it in by drawing from their retirement savings because it's killing the golden goose. And they also don't want a monthly principal and interest mortgage payment. So traditional financing isn't going to work for them. So they don't move there. And the builders get frustrated. They're like, well, here's what people want. Can you do that? Absolutely. With the HECM for purchase, we can do this all day long. We can give them all 4 things that they want. In the process, the real estate professional makes a commission, not just on a smaller home, but on a bigger home, right? Expanded borrowing capacity. So the builder wins, the client wins because they get what they want, the real estate professional wins, and of course, we're able to sell another loan. I'm not going to go through the eligible property types. You know, if you've done an FHA loan in the past or an FHA insured product, this is not an FHA loan. It's an FHA insured loan. But the one thing I did want to mention on this screen, we had a woman buy a quadplex with a reverse mortgage. What an amazing strategy. She bought a 4-unit property using the reverse mortgage on the entire property. She only occupies 1 and she rents out the other 3. So her financial advisor said, hey, based on what we saw before the transaction, you were going to run out of money approximately by age 84. Now she'll never run out of money. She said she doesn't even need to draw from her retirement savings because those other 3 units cash flow to the point where she doesn't need to touch her retirement savings until her required minimum distributions. And the financial advisor said, you just completely changed her retirement outlook. That's how these blend together, right? Real estate, financial planning, and mortgages all come together to create a more efficient outcome for this client. She'll never have to worry about money ever again. All right, so here are the 4 motivations that we hear people talk about when they're thinking about using a HECM for purchase. Some want to relocate to be in other geographic areas. Would I want to be in your area, Eddie? Yeah, I would love to, right? Maybe someday, but there are very attractive places to live that aren't anywhere near my workplace. I don't care about that anymore. I don't need to be close to work, right? I can move closer to the coast. I can be closer to the lake or the golf course. I can be closer to my kids and grandkids. Some people want to downsize. Now, we call it right sizing. We've been told that in some markets, downsizing is a derogatory term, so we've stopped using it. I don't see it, but if that makes people feel uncomfortable, let's talk about right sizing. Right sizing has the connotation of a widow in a 2-story home with 5 bedrooms, 2.5 baths on a full basement and 5 acres. Is that the appropriate place for them to be as a widow? No, probably not. So should they be in a ranch style home, single floor, no stairs, quarter acre, in a nice community, nice safe community? Yeah, maybe
Probably a
downsizing or
lot
right
safer.
sizing. Yeah. So there are houses that meet their physical limitations that might be a better fit, and we'd rather they be in the right house, which means we need our real estate professionals to help with that. Some want to upsize. In fact, when I was selling, I don't sell reverse mortgages anymore, but when I did, most of my clients were upsizing. They were going to the 55 and over communities. They're pricey, but they're fantastic. I love those communities because, Michael, they have pickleball courts there. You gotta love that. So yeah, I mean they've got casino night on Friday, and they've got some of their meals taken care of, and they've got all these amenities that are fantastic. Well, that's expensive, and a lot of people look at it and say, "Nah, I can't afford it." Yes, they can. They just don't know that there's a product that will help them through it. The last motivation may be surprising to some of you, but gray divorce and silver divorce has exploded over the last couple decades. People are divorcing at their older ages at much higher rates. Now, divorce in America is actually down, but not among baby boomers. It's actually exploded. Gray divorce has doubled in the last 20 years, and silver divorce has tripled. Silver divorce would be the older boomers. And so, can we help with that? Sure, we can. There's two different strategies, and it requires real estate professionals to facilitate these strategies. Number one, they're going to sell the marital asset and go their separate ways. It's pretty common. They're like, this is our house together. It's a community property state. You know what? Let's just sell it. We're going to split up the equity 50-50. Can they take that equity and go and buy a home using a HECM for purchase? Absolutely. And the first time I did this, the same real estate professional got the listing and 2 sales. Guys, 3 transactions, all because he understood how to facilitate a divorce. Now we got 2, right? We got 2 HECM for purchases out of it. All right. That's one strategy, is sell the marital asset and go your separate ways. The second strategy is called a spousal buyout. I know you guys probably know this, but one person says, this is my house, I'm not going anywhere. But they have to pay the departing spouse, right? They're going to have to leverage money from this equity by doing a reverse mortgage. Now, they could just draw it all out of their retirement savings and screw their retirement plan for the rest of their life, right? They could do that. And that's generally what most of them will do. And their retirement will forever be damaged as a result. But why not just draw money from your reverse mortgage on this property, take that money and pay them? And in many cases, we can pay them at closing. Okay, we can actually pay them when the loan funds is a departing spouse. That's called a spousal buyout. Now the spouse has money to go around and shop. And what do? They rent. Most of them will rent because they don't realize they can take that money and go buy a home if they work with Eddie and Michael and others at Movement Mortgage. We know that this person can go and buy a home. And we'll tell them what they can afford using a reverse mortgage. Okay, moving on. This is coming from the National Association of Realtors, and it just shows you what a powerful force the baby boomers are. You'll notice younger boomers and older boomers are lumped, are split up. Because if you lump them together, it would extend across the 3 screens on my computer in front of me. You wouldn't be able to fit it in an infographic because they are such a large force in real estate today. Now, the dark blue is buyers. 23 and 16 brings us to 39% of all home buyers in America right now are baby boomers. The lighter blue is home sellers. 30%, 23%, 53% of all home sellers. Now, the reason there's less buyers in the baby boomer community is because some of them are selling and moving in with family members. Some of them are selling and moving into a nursing home or assisted living, right? Some of them are selling because they need the money and they wind up renting, right? So what we find is 53% of all home sellers, and yet here we are talking to Gen Ys and millennials. They're insignificant. we need to be talking to baby boomers. If you want to expand your business, we need to all be talking to baby boomers and older. I'm not going to go through the purchase fundamentals. I know we're running out of time today, but just know it does require an FHA appraisal. It's not an FHA loan, it's an FHA insured product. I know this impacts you because of your market. That's a cap on the usable property value. Now, will we do a $2 million property? Yeah, all day long. Yeah, Michael, you do multi-million dollar properties all day long, even with a HECM, even though we're restricted to 1.149 million this year. Just know that we're expecting that to go up on January 1st. Michael will tell you what the new limits are. It's basically a high cost limits. We're expecting that to go up.
And there are jumbo HECMs, right?
There are.
Absolutely.
Michael, you had a big one. Didn't you have one that was in the several million range, or
Yeah,
you were looking at one?
6 million. Yeah, $6 million property in the San Francisco Bay Area. Yeah.
Wow.
So,
Absolutely. We'll do
you
those all
know,
day long.
and one thing I wanted to throw out there before we wrap up is, we guarantee a 17 calendar day close on these. I mean, obviously, we want to have all the documentation in already from the client, have them pre-approved so they're not scrambling around trying to get us stuff. But we can close these fast, and it's not a loan that's slow. We just get everything done up front. I mean, I had one that we got the purchase and sale agreement in on July 22nd, and we funded it on August 1st of this year. So we can close them fast. We don't like to close them that fast because it stresses out the team a little bit, but we certainly can. And, we just make sure that, we got everything squared away up front so there's no surprises. Obviously, Ed, you do the same thing on the front
Yep.
For your forward loans. So that's just how we do it. So don't worry about that. And it's amazing to me. I had a transaction coordinator for a real estate firm that had her own reverse mortgage that called me and said, boy, I didn't even know that you could use a reverse mortgage for purchase. And this lady's working for a real estate company. She's got her own reverse mortgage, and she had no idea you could use it for a purchase. So, one thing I always like to do is call the listing agents once the offer goes in, just to let them know, hey, we can close this fast. There's not going to be any surprises. It's not going to be, this long drawn out closing. I think the biggest thing we run into is a lot of people are contingent, and nobody really wants a contingent offer. So, that's probably the biggest challenge I run into on the purchase side, is contingents. So.
Makes sense.
This is just estimates. Of course, we actually provide more now since rates have dropped a little bit. When rates go down, we can actually provide more. But this would be my uncle's scenario, right? He's closer to age 82. We were able to get him 50% of his sales price. We were able to contribute, which means he only needs to bring 50% plus costs. All right, so that would be an upsize example. We have a downsize example. I'm not going to go into a lot of details on that one, but I did want to mention we have a new HUD policy change this year that has been huge for us. And that is that interested parties can now contribute up to 6% of the sales price. Historically, working with our real estate professionals and especially builders, they would write the contract and we'd be like, no, you can't do it that way. The reverse mortgage doesn't allow any interested party contributions. And the builders would get frustrated and say, but we offer $5,000 towards closing costs. I said, not on this product, you don't, because HUD wouldn't allow it until now. And we actually had a lot to do with that. Some of us get to go to DC each year and they ask us questions like, why can't you sell more HECM for purchase? And our automatic response every time is, because you won't let the sellers and builders contribute towards costs. Now they did. So finally, HUD has listened. And by the way, that I would also add that there's really not much that's different with the NAR settlement changes, other than we need the borrower's agreement. If there's a borrower agreement, we need that. Michael, is there anything else that was impacted? And the agency fees do not eat up that 6%. There's no, it doesn't impact that at all. Real estate commissions are not impacted. That good?
Yeah.
Oh, there it is. I actually had it built into the slide deck. Buyer agent commissions may be paid by the seller and are not considered interested party contributions. If you want to learn a little bit more, uh, I wrote a book called Understanding Reverse. It comes out every year. It's available on Amazon. It's been the top seller for about 10 years. Harlan, our national director, wrote a book that's very different, but equally important. Mine is the nuts and bolts of how a reverse mortgage works. Harlan's book tells you why you should do it. So he goes into some of the financial planning advantages and the usage. It's basically a practical application of my book. So I would encourage you to take a look at both of those. And if you have any questions, you're going to talk to Ed. He's going to be your first point of contact, right? So if you're a realtor on the call, if you're a client, you're going to reach out to Ed. And Ed will work with Michael to facilitate the reverse if the reverse is the proper path for that client.
Yeah, Michael's been an amazing partner. Thank you so much for all the clients that you've spoken to and taken the time with. I mean, it's been awesome couple of years working with you. And like I say to all of my clients, I'm like, I've got a partner who just does reverse mortgages. I focus on the forward, and we are very symbiotic when it comes to that, and very good at communicating, very patient, and very straightforward with our clients. I mean, there's no beating around the bush. Numbers are numbers, right? But again, a lot of this is about lifestyle and planning. I mean, and if we don't get ahead of it, it's going to catch up to a lot of people. So I really appreciate you guys taking the time. Thank you so much.
Absolutely. Thanks for the invite.
Thanks for having us
Always
on.
learn so much for every time you guys come by and help out. So thank you. And please, next time we're in San Diego, you got to give us a shout.
Yeah, absolutely. I have my favorite restaurants there.
Yeah, I'll introduce you to some new favorites.
There's about 20 of them right downtown. So
Yeah, there are. There's a
yeah,
lot of little hidden gems all over the place.
yeah. Well, hey, thanks for the invite, guys, and just reach out if you have any questions.
Absolutely. Thank you guys. It's
Absolutely.
gonna be an awesome week. Take care.
Thanks. You
Thanks,
too.
guys.
Good luck.
Really
Good luck
appreciate
with
it.
your phone.
All right.
I just looked at mine. It's still on SOS. So.
Yeah, ditto. All right. I'll see you guys later. Take care.